Hi, Mark Tapp with your Tapp's Tips here. Today I want to answer one question in a series that I've put together of questions that are most frequently asked of me. This is a great question, and it's asked on a fairly regular basis, and I think it's just a great question for people to ask because they get a better understanding of my industry, and that is, how are you paid? So when somebody asks me how I'm paid, there's several different ways that I'm paid, and we can kind of maneuver things depending on your situation and your needs. Obviously, I need to make money. That's why I'm in this business. That's why I have a job, is to make money. And obviously, the side effects of that, I like to help people, but at the end of the day, I've got bills to pay, just like you do. And so when we sit down to work out a transaction and to figure out what our income is going to be on that transaction, there's several different sources of income. Many of you have heard of an origination fee. I am technically a loan originator. I originate a loan when I sit down and talk to you and take an application. And you pay a percentage based on your loan amount for that service, for the help that we provide. So, and generally speaking, that's 1%. That's an industry standard. So expect when you're sitting down with me or someone else to hire them on as your professional to help you in your transaction, whether it's a purchase or a refinance, expect that you'll pay 1% origination. Now, they may not charge you, or I may not charge you an origination out of your pocket. So how does that happen? Well, every day when I sit down at the computer, I get in my email a series of rate sheets from my lenders. And those rate sheets have a list of each rate that's available and the cost or the yield from that interest rate. So to give you an example, probably today on my interest rate sheets, I would have 5% and then a series of rates above and below that. And they're in 1/8% increments. So we would have 5 1/8, 5 1/4, 5 3/8. We'd also have 4 7/8, 4 3/4, 4 5/8. And it would probably be a range of 2%. And each of those rates has a cost or a premium that is paid. Let's say you were to accept an interest rate above 5%. 5% is what we would call the par rate. It's where no premium is paid and you don't have to pay to buy it down. At 5%, that's our center point. So 5 1/8, the lender is going to make more money every month when you pay your interest. And so they're willing to give a little bit of that back. Actually, it's sort of an enticement. They'd like for you to take that higher interest rate because they're going to make more money, theoretically. So let's say you came to me and you said, Mark, we don't have enough money to pay all of our closing costs, and the seller isn't willing to pay them either. What are our options? Well, we could increase your interest rate to, say, 5 1/2. And that would generate enough premium from the lender to pay for your origination fee. And it might save you money over the long haul. Now, the trick there is at 3 to 5 years, that's your break-even point. So if you're planning on staying in the home for longer than 5 years, generally speaking, it's better that you don't pay for your origination fee out of premium. You don't have to stop at the origination fee either. Sometimes, it's a little harder in today's environment, but sometimes we can pay for all of your closing costs out of premium. And in a short-term transaction where you're only going to be in the house for 2-3 years, that can be a really good way to save money. Now, on the reverse side of the coin, you can buy your interest rate down. So let's say today's par rate is 5%. You want to say, have 4 3/4 or 4 5/8 for an interest rate. You might pay 1 to 2 points additional to get that interest rate. In some environments and in some situations where you're going to stay in the property for a long time, that can be great. So back to how I get paid. I am a wholesale, or I deal with wholesale lenders. So to give you an example, Wells Fargo has a retail department that you can go to. Go down to your local bank, that's their retail department. They also have a wholesale department that you can go to, and that's me. I go to their wholesale department, and then you deal with me on the retail side. So it's just like going to your grocery store. They're the retail outlet, and they buy things at wholesale. So 5% might pay a premium of 1/4%. And that's 1/4% of your loan balance. So on a $100,000 loan, it would be $250. Generally speaking, when I price my loans out, I expect to make about 1 5/8, 1.5% on each of my loans. So I'm going to price out 1% to you, and I'll probably make a yield spread, what we call yield spread from the lender, of somewhere between 1/8 to 1/2%. And depending on your loan amount, that could be a couple $100, or it could be another $1,000 or so. And you have the choice, again, kind of by buying down your interest rate, you have the option of, instead of having me take that higher interest rate and receive premium, of paying additional up front above and beyond your origination fee to buy that rate down. Okay? So really part of the importance of this question is understanding that everyone in the industry has to get paid. Nobody's going to make it very long if they do loans for free. And you as a consumer, if you're truly looking to work with a professional, it's going to be somebody that you want to work with for the long haul, so you have a vested interest in keeping them in business. And so when you're out there looking at the various professionals and you're looking for somebody to work with, just understand that if they're telling you they're not making anything on let's say they're not going to charge you an origination fee, or let's say they actually say, I'm not going to charge you anything, be very careful about working with that person. You need to understand that everybody's going to make money, and they're either going to make it from you in the front end, what we call the front end, which is the origination fee, or they're going to make it on the back end, which is the yield spread premium. And if they make it on the back end, I can guarantee you that 3 to 5 years out, you're going to be worse off having done that loan than having worked with somebody that quoted you an upfront fee. I hope you enjoyed this information and found it helpful. I have a series of videos that are at your disposal for no cost. If you would like more information, you can go to www.findtherightmortgage.com/free videos. And there's a whole host of information there. Hope you enjoyed this. You have a great day.